Good day everyone, I'm Hugo Besaidenout, responsible for investment distribution at MFP. Welcome to today's MFP Outcome Matters, where I will be your host. It's been an incredibly fast start to the year for many, if not all of us. So much so that I feel like I need a holiday already. Unfortunately, no such luck in the near future for me. In the markets, the US have got off to a flyer with the S&P 500 up 8% already, but still largely driven by the Magnificent Seven. We have also seen the rise of the granola stocks, which were the main drivers of the European Stoxx 600. I won't cover which stocks they are, but if you're interested, you can just Google it. That's granolas, like the food. Unfortunately, it hasn't been a good start for our local market though, and the higher for longer interest rates narrative and the continued negative sentiment around economic growth linked to infrastructure and load shedding challenges aren't doing our local economy any favors. Our panel discussion will cover where we see growth coming from for the year ahead, so I'll leave it up to the smarter people in the room to unpack. Before we delve into the session, let me address a few housekeeping matters. We've applied for Continuous Professional Development or CPD points, recognizing their significance to you. To make sure your attendance is verified, kindly watch the entire session and provide your ID in the CPD section. The event platform will be accessible until the end of April, granting you ample time to revisit the content and secure your CPD points. Before the end of May 2024, you will receive a separate email from the Momentum Sales Academy containing your CPD certificate. During this webinar, we encourage active participation. Feel free to pose any questions in the Q&A section and our speakers will address them in real time or respond after the session. First up is Sonia Steyn. Sonia has recently been appointed as the Head of Strategic Wealth Management and Advice for the Momentum Advice business. Those of you that attended the MFP conference may have met her. I've personally known Sonia for nearly 10 years and look forward to seeing the impact she will make in this business. Sonia will briefly discuss what a vision for wealth management and advice is for MFP. Welcome Sonia to your first Outcome Matters.
Thank you, Hugo. Good day to all the MFP financial advisors. It was very special to attend my first MFP conference last week on Thursday and Friday. I enjoyed meeting some of the advisors during this time, but I'm also looking forward to meeting each one of you in person as we get to engage more frequently. At the conference, there was a central theme emphasizing the technological and digital developments, some of the changes and enhancements shared by all the speakers and product providers across the business. This is also an imperative to manage costs and efficiencies in all channels and business units. Technology is the way forward, and this also applies to the world of advice and how we give advice to our clients. Technology is changing our clients' behavior. As we've seen since 2020, 2.9 billion of people are actually active on social media. And in 2025, 72 million of jobs will actually be created by digital platforms. This behavior impacts on the way clients interact. For them, life is absolutely on demand. They do online shopping, they order food and even rides online. So people feel very connected on social media. They associate with groups of like-minded people and are part of e-communities. Now we've seen with some of the new mega trends and AI trends in technology, it changed two things that's very important for our practices in future. One is how clients want to interact with advisors in future. And the second one is also how clients want to interact with the advisor's practice going forward. So the question is, how will we showcase and demonstrate this value to our clients in future? Now, as I shared with you in the conference presentation, you need to build your practice to become a business of advice, to enable you to create value for your clients in future. Well, unfortunately, research is confirming that we are falling short on this. Now, we know when we dispense advice, advice is always on two levels, one above the line and one below the line. So below the line is always the questions that we ask our clients, the what and the how. And it's all about the client's money. So here we talk to our clients about their specific need, let's say it's retirement need, the RA that's perhaps the best vehicle for the client, and the funds to use within that solution. But all of these things are actually tangible things, and we see that these are things that we actually put in our record of advice. But we cannot do this without using our above-the-line advice as well. So it's got to be in conjunction with all those why questions to the client. So here's how we actually give meaning to clients. We talk to the person. So here we want to help the client to understand the complexities of the world that we actually live in within the investment world. Also to help the client to build scenarios to absolutely have peace of mind. And for most clients, it's really not important in what funds or solutions are invested. They just want to know that they're okay. So in our world, we need to use what we call the OK index. The OK index will help your client to understand, if inflation goes up or returns go down, what is the impact on my investment and will I be okay? So this is very important. This is the information that we actually put in our financial plan, and this will anchor your relationship with your client in future. So we've also seen that from an investment perspective, there's a real investment margin squeeze on fees for the past 20 years. So with asset management fees, we can see that absolutely came down. Same with platform, it's absolutely a race to zero, and we can see that as well in DFM fees as well as fund managers fees. So the only one we actually have that we could increase in time is advice fees. But you can only do that if you have demonstrated value to your client. So we've seen there's been a whole new evolution of the advice model in our industry. So previously we've seen that it is totally a self-centric model, where the product providers was important, the number of products that you offered your client was the important part, salespersons, and then obviously the client actually came last. Now we see that has moved totally to a client-centric model, where the clients are important and they come first. Then the advisors to support them and give them that advice that they need, which is anchored in proper evidence-based advice solutions, also anchored in advice principles and philosophies. So it's very important to also understand what is the business of advice. How does a practice like this actually look like? And then from a momentum advice perspective, what is our short definition there? So it's all about advice. Advice is your solution to the client. And it's how you actually unlock the value of that while you talk to your client and how they experience that in the practices and the processes within your business. Now, applying a wealth management principle and philosophies are very important when you engage with clients. Now, I always say this is the most important bit to me from a wealth perspective, because it's very important for you to have an investment philosophy. So I always ask the question, so if you can answer and describe what is an investment philosophy to your client without using the words performance or return, then guess what? You have a proper investment philosophy. If that's not the case, then that is something that you need to work on to create value in your practice. So investment philosophy is also very important to your business, because it actually gives you the opportunity to grow critical mass in your business. So there's more clients in the solutions in your practice. And that means that you can actually work with more clients, because some of them are in groupings, and that makes it much easier when you need to do annual reviews and you don't have to do rebalances of your portfolios. So this is very important, especially if you use model portfolios. And when you use Equilibrium that we have in our fold, it's so easy because they give you the full investment philosophy that you can follow and properly articulate to your clients. From a practice perspective, there's also huge benefits to you in your business. Here, from a succession planning perspective, all of the processes, the experiences, everything sits within your practice. So it's not the view of one person anymore. So in that, you will actually have a higher valuation multiple in future to come. So sharing with you just 2 building blocks today on a business of advice. The first one being investment philosophy. Now you will agree with me, what I've shared with you, investment philosophy is absolutely the foundation of your practice to articulate that value to your client. So why is it important then to have an investment philosophy in your business? Well, firstly, it increases the clarity in your investment process. And that's for your whole practice, all your employees, but also for your clients. Everybody understands the process. Then secondly, if you use model portfolios, they can be constructed to align with the investment strategies, the benchmarks, and the information that you applied in your financial planning process to meet the client outcomes. Then in the third place is to ensure that investments are consistent. So what we mean by that is, especially when you illustrate this upfront with your client, when you invest them in a model portfolio within a certain timeline, the client knows exactly what the volatility during this time will be, and they know what to expect from this model portfolio into the future. And then the last one is this can absolutely help you to differentiate what you do from your competitors. Now I know there's a lot of other businesses out there offering model portfolios as well. But the important bit here is for you to take your investment philosophy, make sure you can articulate that, build it into your advice processes in your practice, but then also align that with your specific client value propositions. I can assure you, this is a winning recipe. So to take you to some research that was done on model portfolios across the world, it was done by Natixis Asset Management. And they actually interviewed private wealth practices, investment practices, and all retail practices to see what the benefit in their practice are when they use model portfolios. So as you can see there in the blue block, it absolutely helped them to explain performance to clients. And as I've shared with you just now, it's easy when you have a time frame, you have an investment strategy, and your client knows exactly what the volatility will be and how the model will react to that. So some of the practice said, 77% of them said that models absolutely help them to manage risk. And then 69% also said that this actually brings in another layer of due diligence in their practice. And also from a client perspective, it helped them with that relationship also, because 82% of the practices also said it was so much easier to implement model portfolios. You don't have to go to asset allocation, you don't have to do any of that, it's already aligned with your client's outcome. And then 77% said that models gives you an absolutely consistent investment experience. So let's move on to building block number 2. This is to make sure that there's multiple client value propositions in your practice. So I just want to share some research with you done by PwC very recently. And they reported that, especially in a high income market, the market is definitely shrinking for those clients. And these clients want more specialized advice from advisors. So if that is the case, you cannot go with just your business value proposition to these clients that actually covers all clients. You need to focus on specific segments of clients to be able to attract new clients in your business going forward. So here you want to see segments of, let's say, engineers, SMEs, etc. So that you need to focus on them in your practice. So I'm showing you a couple of examples that you could use, let's say, in social media, because this is where the place is where these people actually hang out, and it's very important to know where they have groupings of like-minded people. So what you can see here is just one-pagers with a specific segment in mind, where you can showcase that you have a deep understanding of the specific segment group, but then that you can also show that you know how to add value to them in this space. So ending off then, cost is only an issue in the absence of value. So in summary then, these were a couple of the key takeouts from my conference presentation, which will be part of my focus areas going forward. I'm looking forward to sharing my strategy and framework for wealth management and advice with you in the near future, to be able to equip you to build a business of advice, which in turn will create value for your clients and allow you to charge for advice in the future. Thank you.
Thanks, Sonia. Certainly exciting stuff on the horizon. Next is our economist, Tanisha. I just want to extend my congratulations on her recent award as runner-up for the most watched masterclass at the Asset TV Awards. You continue to deliver excellent insights, and we look forward to your discussion today. Sanisha will unpack the 10 macro trends to look out for in 2024. The floor is yours, Sanisha.
Hello everyone, and thank you for joining us again. Investors grappled with an unusually difficult time in financial markets last year. Initially, there was a widespread belief that a surge in interest rates over the course of the prior 2 years would trigger recessions globally in 2023. But this expectation turned out to be wrong. In January of last year, the Wall Street Journal consulted a panel of 70 economists to gauge the likelihood of a recession in the upcoming year. The average estimate stood at 63% a year ago, but it has since dwindled to 39%. Contrary to earlier predictions, economic growth surged throughout 2023, maintaining a robust pace. Despite concerns about too high inflation and the consequent interest rate hikes designed to quell these price pressures, consumers surprisingly increased their spending rather than cutting back on it. Households were supported by pandemic savings and a robust jobs market, with unemployment remaining at historically low levels. Additionally, the initial assumption that rising interest rates might lead heavily indebted borrowers to struggle with their obligations also proved to be less impactful on the economy than initially anticipated. This can largely be attributed to 3 key factors, including a higher services component of the United States economy than what was the case historically, the availability of a wider range of instruments to hedge interest rate risk, and a larger proportion of fixed-rate mortgages, which locked in households at more favorable rates than where they are currently today. While there is a shared belief among investors that a severe and prolonged recession is likely to be averted this year, there is an expectation of a slowdown in global economic activity. This deceleration is anticipated due to the delayed impact of previous aggressive monetary policy tightening, constrained fiscal flexibility, and higher than targeted inflation. Moreover, unforeseen geopolitical events are poised to continue as unpredictable variables, influencing the political, the economic, and financial landscapes in 2024. In today's session, we will delve into 10 pivotal trends within our macroeconomic purview for the current year. Topping the 10 trends on our macro radar is the expected shift in the trajectory for economic growth. We raise the question of whether economic resilience will prevail or whether the impending gravity of previous monetary policy actions will act as a negating factor in 2024 for what has so far been relatively strong growth. Despite ongoing conflicts such as the Russia-Ukraine and Israel-Palestine wars, the global economy displayed resilience over the course of last year. Initial concerns about an imminent recession due to a sharp rise in interest rates to curb inflation were proven overly pessimistic. Inflation is receding globally, unemployment rates have generally stabilized at low levels, and major central banks have paused tightening measures and even hinted at the next leg down in monetary policy. Nevertheless, the foundation of this economic resilience appears a bit fragile. The potential lagged effect of higher interest rates and increasing corporate bankruptcies, particularly in the US and Europe, poses risks to economic stability in the year ahead. Moreover, growth in the world's second largest economy, China, looks wobbly after previous stimulus injections failed to offset the slump in the property sector. Authorities in Beijing did nevertheless back-end load support measures late in 2023, and these should start to deliver enough support to sustain growth levels in China at somewhere between 4.5% and 5% for this year. Our second key macro trend focuses on the shift from synchronized global economic activity in a post-pandemic world to varied trajectories in economic growth across the world as policy reactions start to shift. Although the international economy has defied expectations with its resilience last year, the International Monetary Fund, or the IMF, estimates that global output remains almost 3.5% smaller than if the pandemic had not happened at all. Varied fiscal and monetary policy responses led to differential economic outcomes across the globe. These disparities in growth outcomes are likely to persist, with advanced economies benefiting from an earlier post-pandemic reopening, the availability of more effective vaccines, robust stimulus measures, and a quicker labor market recovery. In contrast, low-income and developing economies face larger output losses due to higher interest rates, depreciated currencies, and lagged inflationary pressures. Consumer spending strength in the US is anticipated to decelerate throughout this year due to the gradual depletion of pandemic-related savings, coupled with a less supportive labor market, particularly as the demand for labor dips. What's more, the lagged effect of tighter interest rate policy is now negatively affecting fixed investment intentions. Across the Atlantic, the slowing of the Franco-German growth engine will constrain economic prospects for Europe. Given the quantum of public debt incurred during the pandemic and then again during the war in Ukraine, the ability of governments in Europe to stabilize the economy through increased fiscal spending is starting to diminish. This is particularly true for heavily indebted nations. In addition, pressure on real wages and ongoing geopolitical conflict point to further growth headwinds for the region. Despite earlier criticism from investors regarding China's restrained fiscal and monetary policies in 2023, substantial policy announcements made later in last year are now poised to have positive effects on growth this year. These measures are expected to stabilize the housing market as well as enhance consumer sentiment. Nevertheless, Chinese authorities' dedicated focus on higher quality and more sustainable growth suggests a lower growth channel from here. Across the globe, the combined impact of the pandemic, the conflict in Ukraine, and escalating climate crises have reversed the long-standing trends in poverty reduction. This has led to an increased gap between the wealthier and less affluent nations. Constrained fiscal space and heightened debt vulnerabilities in certain regions have set back the convergence of poorer nations towards the living standards of the higher income economies. Our third trend to watch focuses on the drop-off in inflation and the pace of deceleration it will assume this year after surprising most investors positively in 2023. The Bank for International Settlements notes that wringing the last bit of excess inflation out of the economy takes longer than those initial phases of reducing inflation. Global inflation has already more than halved from its peak in 2022, but challenges persist. The IMF warns that inflation in most inflation-targeting countries exceeded central bank targets last year, and it expects this to continue for this year. Only by 2025 is headline inflation anticipated to be close to target in the majority of the world's economies. This next phase of decelerating inflation is expected to take longer due to various factors, including waning food and energy base effects, geopolitical strife affecting global supply chains, potential demand pickup as real wages recover, and political pressures to ease policy in a slowing economy. With the market currently pricing in what we view as an overly aggressive 6 interest rate hikes for this year in the US economy, we would also like to highlight the potential risk of the Federal Reserve making a policy error and stirring up inflationary pressures further down the line. Our fourth trend to watch highlights the importance of collaborative efforts between monetary and fiscal policymakers. Monetary and fiscal policies as essential economic functions are closely intertwined. The pandemic demonstrated the two need to be well coordinated, and it taught us lessons about when these policies work against each other. Although fiscal support can buffer an economy during a downturn when inflation is high and persistent, fiscal support across the board may actually seem imprudent. This would force central banks to hit the brakes even harder to maintain price stability. Fiscal responsibility through credible frameworks is crucial to address debt sustainability concerns. This can be done by rebuilding buffers that can be deployed in the event of the next economic shock. This won't, however, be an easy task in the years to come, given the structural shifts of an aging population, the move to net zero carbon emissions, and increased defense spending amid rising geopolitical tensions. The world economy was a complicated place even before the tragic events unfolded in the Middle East. However, the conflict between Hamas and Israel has introduced a new layer of uncertainty. Airstrikes launched by the US and UK in Yemen in response to attacks by Houthi militants have seen tensions rising in the Red Sea, placing restrictions on global trade once again and forcing nations to reroute cargo. Global political tensions are expected to remain heightened in the coming quarters, with a significant number of elections worldwide in 2024. The Economist suggests that over half of the global population, that is 76 countries, is set to undergo elections this year. The Democracy Index from the Economist Intelligence Unit anticipates that only just over half of the countries it covers will witness entirely free and fair voting processes. This is suggestive of global economic power increasingly shifting toward autocratic rule. While voters in the US represent only a small share of the global economy, the US election outcome will be pivotal for all from an economic and a security standpoint. The Republican frontrunner and former President Donald Trump has garnered a substantial lead over incumbent President Joe Biden in several swing states where polls have been conducted, suggesting the potential for a second presidential term for Trump. In this scenario, we anticipate an increase in economic nationalism with a rise in trade barriers. The US would also likely withdraw from an active role in global affairs. Additionally, under a second Trump term, there may be a rollback of regulations, heightened scrutiny on fiscal sustainability, and increased attention on central bank independence. This outcome would also leave the Ukrainian population in a more uncertain situation, as the extent of military assistance gets scaled back. South Africa will also make its mark on the busy political calendar this year. Our sixth trend to take note of focuses on SA's political future. A decline in voter participation and significant gains for fringe political entities at both extremes of the voter base may be indicative of SA's evolving democracy. Yet, these trends could also, more worryingly, signify a more fractured society. The ruling African National Congress, or ANC, continues to govern with a reduced majority, but this majority is likely to be challenged in the foreseeable future. The ANC's support has waned due to the energy crisis, logistical breakdowns, and its failure in making enough progress on tackling corruption. The National Prosecuting Authority's inability to prosecute influential figures linked to state capture further hampers SA's chances of being removed from the grey list by 2025. On a provincial level, the potential for a coalition-led government looms larger, especially in Gauteng and KwaZulu-Natal, which collectively constitute 44% of SA's population and 49% of SA's GDP. Potential scenarios for national election outcomes range from an ANC-led coalition or marginal ANC majority, suggesting a less stable political environment, all the way to a retained ANC majority with a firmer mandate. In the latter case, a more stable policy environment could emerge if the ANC and the incumbent president pursue their agenda more assertively. However, polls suggest that the probability of a retained ANC majority is dropping. While load shedding is still expected to detract from SA's economic growth in 2024, improvements in Eskom's generation plan and increased private sector investment in renewable energy suggest a potential easing of the energy crisis. Lower anticipated levels of load shedding could translate into a smaller 0.8 percentage point detraction from GDP growth in 2024 relative to the 2 percentage points estimated by the South African Reserve Bank, or SARB, for last year. While the energy crisis begins to taper off, logistical challenges, particularly in rail and ports, are likely to take its place and features as our seventh trend to watch this year. Rail inefficiencies alone are estimated to have cost the economy around 5.5% of GDP last year. Despite government initiatives to address these logistical issues, and this includes the implementation of the Freight Logistics Roadmap, growth projections for 2024 and 2025 are likely to be constrained to 1% for this year and 1.7% in next year in our view. Coming in at number 8 is SA's worsening fiscal conditions. SA's interest burden has surged, with warnings from the IMF that it could reach 27% of fiscal revenues by 2028. Balancing spending reductions, tax increases, and managing state-owned entity challenges will be critical for fiscal consolidation. Although government proposed to plug the financing gap in the current fiscal year without having to raise government bond issuance by much, pressure on SA's local market will escalate in the coming quarters as SA's redemption profile ramps up. Swift and effective monetary policy actions, coupled with clear central bank communication, averted a prolonged divergence in inflation expectations in SA. While acknowledging potential inflation risk from geopolitical factors, currency fluctuations, and administered prices, we anticipate that demand-driven and wage-related inflation will remain contained in our 9th theme, depicting a breather from inflationary struggles. Our projection sees headline inflation averaging at 5.4% in 2024, decreasing to an average of 4.5% by next year. Finally, in our 10th trend, we caution against the likelihood of continued central bank caution in spite of falling inflation and the expectation of steady to falling rates. While there has been a positive shift in inflation drivers, concerns linger over currency weakness and geopolitical factors affecting global food and oil prices, which typically have a larger effect on lower income households which spend more of their wallet on food and rely more on public transport. We expect the first interest rate cut of 25 basis points by the second quarter of this year and estimate that we get 3 cuts in total for the year. Serving as navigational aids for the year ahead, these trends are poised to shape the fate of global politics, economics, and financial markets in the coming months. Even though investors are pricing in closer to a smoother landing, 2024 could still present a challenge to investors as we navigate a world of fragmented economic growth and higher volatility risk stemming from increased geopolitical tensions. I thank you for your time.
Thank you, Sanisha. We'll be keeping our eyes on these trends and we'll be hoping for the more favorable outcomes. Next is a panel discussion moderated by the Head of Equilibrium Investment Management, Flobella Yates, or Flof as most of us know her, who is joined by Mike Atzitz, our Chief Investment Officer, and Rian Bosch, a Portfolio Manager at Equilibrium Investment Management. They will unpack their views on where they expect growth to come from. But before I bring them on, I would also like to congratulate Mike for winning the most watched institutional masterclass and Flof with multiple awards, most notably Most Watched Person at the Asset TV Awards. Well done and welcome, guys.
In a low return environment, more and more advisors are asking us about where returns are going to come from. When we do our modelling, we always look through the cycle and try to ignore the short-term news. Mike, can you quickly share with us, as the Chief Investment Officer of Momentum Investments, what our asset class forward-looking views are?
Thanks, Flobella. So over the last couple of years, we've seen a little bit of a paradigm shift of where returns come from in the market. So we've gone into an environment of lower growth and high inflation, with the consequence that generally the returns available on asset classes have reduced significantly. So if we think about the real returns that you can get on equities and listed property in the long run, you're looking at real returns of 5 to 6%. Interestingly, what we are also seeing is that some of the real returns on the fixed interest asset classes are improving. So there's not a huge dispersion between the expectation of returns between equity and fixed interest. It's very predominant in the South African market. You do avoid some of the upside optionality of local equity if you go into the fixed interest market. In offshore markets, you've also seen a big convergence of returns between, let's take out the Magnificent Seven of the US equity markets, but the valuation gap and expected returns between even US equities and what you can get on a 5-year bonds are a lot closer. So what you are seeing is there's a little bit of convergence of returns. Obviously, the different asset classes have significantly different return drivers and risks associated with them. So diversification remains important. But ultimately, what is driving a lower return environment is lower growth around the world. To have a higher return environment, you need higher growth and much higher inflation. Inflation has been high for a relatively short period of time, but nowhere near the 1970s or 1980s. And we're slowly seeing a rollover of inflation as it's coming down, but it is quite sticky. So, I mean, it's a very challenging environment from an asset allocation perspective because there is a little bit of this convergence of return and there are a lot of risks in the system. Outside of South Africa, there's big geopolitical risks, so that can have a significant impact in terms of the oil on inflation. And even in South Africa, as an election year, you know, what happens post-election, what policies come into play, what are the implications? So for the fixed interest market, so the yields we're getting on the fixed interest market at the moment are very high. But depending on the outcome of the political environment, you can see a very different play out. So if there's a more centrist, and that's our likely base case, a more centrist government with sensible policies, we see good upside potential in fixed interest asset classes. If we get a more radicalized political formation, the risks manifest in the other direction. So, yeah, we do scratch our heads in terms of where the returns are coming from. Realistically, a good return in the current environment is a real +5, 6%, but that's also on a longer term basis. You know, it's not the days of 20, 30% returns. I say that, and last year the American market gave that, but it was in a very concentrated part of the market, and it's no guarantee that that will repeat again.
So is it fair to say for advisors looking to advise their clients, looking for CPI plus 4 or 5 net of fees is reasonable, but above that is going to be maybe a little rough, but not in a straight line, and it'll be a little bit more difficult.
The higher the return you want, the more risk you need to take. And the thing about risk is it can work in both directions. So putting on more risk doesn't guarantee that you're going to get a better return. In the longer run, on average, you should be in that space, but taking risks means that things could go wrong. So shorter term volatility, and our expectation is volatility is going to be quite high, and that can play havoc with portfolios. So you really need to think about the breadth of the opportunity set, take account of the new investment opportunities that come, and kind of keep your head around you. You know, this is not a short-term game. This is a longer-term game. But yeah, it is in an environment with a lot of risk in the system. It's a decision that you've got to make very thoughtfully with consideration of the future and also consideration of the downside risk that you're putting into your portfolios.
Thank you. So given what you've shared, is this an opportunity to explore alternative asset classes? Can you maybe share with me exactly what you consider to be alternative asset classes?
I mean, the alternative is a little bit of a catch-all word. So there's a huge amount of different types of investments that are classified as alternative investment classes. Generally, when people think about alternatives, they think about private equity, they think about infrastructure, they think about hedge funds, they think about commodities, they might even think about direct property. So definitely that is an opportunity set that in our investment universe, in our full investment universe, we think about, but it does come with certain caveats. The one is that there's a lot more illiquidity in the alternative investment asset classes. There's also different regulatory regimes at play. So in a pension fund with Regulation 28, you can go a little bit more into the alternative asset class complex. In the retail space, where CISCA is your driving regulatory regime, there's a lot of restrictions. So even a hedge fund is accessible as a retail investor, but it's not accessible as a component of a portfolio. And that's got to do with harmonization of tax legislation. So that is the intent, ultimately, of the regulator, but they seem to be battling to get there.
Thanks, Mark. Rian, as a hedge fund portfolio manager or alternatives portfolio manager, you've been quite close to the asset class. How do you think about it locally and internationally? And you know, when you're looking at alternatives, it's obviously a different skill set. So do you want to maybe share with us exactly what you look at when you're looking at alternatives?
Yeah, sure. I think to tie in with what Mike said, I think in an environment where we are concerned about growth in some of the traditional asset classes, speaking broadly, alternatives have shown that they can generate returns broadly irrespective or independent of traditional markets. So if we are concerned about traditional markets, then we should look at hedge funds and other alternatives. And again, tying with what Mike said, the alternative industry is broad and basically is a catch-all for everything that is not listed equity, bonds or cash. And hedge funds is maybe the most accessible to a retail investor and can play a very important role in a retail investor's portfolio.
And when you assess hedge funds, do you look at the same aspects that a long-only manager would look at? So, for example, we look at the qualitative review of the house, then we look at the skill of the investment manager. Would you do the same in your space?
Yes, I think because the only difference actually between a hedge fund and a long-only mandate is the hedge fund mandate allows the hedge fund manager some extra tools like shorting or short selling and the use of leverage. And it all comes down to how those skills or how those tools are utilized, which will determine how risky a fund is and the role it can play in the portfolio. And it can be used to either add to returns or diversify, like a different return stream within the same asset class. So it can be used in a number of different ways, and maybe for that reason it is slightly more complex to look at hedge funds and decide the role you want it to play, and then look at specific hedge funds that can fulfill that role in a portfolio.
Thanks, Rian. And Mark, would that be the same for other alternative asset classes apart from hedge funds?
So before I answer that, I just want to add on one thing that Rian said. So my experience with long-only portfolio managers and hedge fund portfolio managers, there's a common saying: in the long-only space, your mistakes get smaller, and if you're doing shorting, your mistakes get bigger in a hedge fund. So one of the things that I have often seen with hedge fund managers compared to traditional long-only managers, they spend a lot more time thinking about exit strategies. So they're much better at defining an exit out of an investment, whereas a long-only manager tends to try and ride his winners for a little bit longer. So a lot more of their focus is on the initial investment case. So I think that's also an important consideration in terms of the blend of skills that you get from hedge fund managers. And because the allocations tend to be a little bit smaller, you need to carry a high cost to pay for all that due diligence. So that's one of the base reasons why hedge funds tend to be a little bit pricier than long-only funds. Just now, back to your question in terms of other mechanisms for accessing alternatives. In the institutional space, it's a little bit easier because you can enter into a lot more bilateral agreements. So you can buy private equity directly. You can do unlisted credit directly to a much greater extent. You can buy commodities a lot more flexibly. In the unit trust space, it is a little bit more difficult. And what you can, but there are options for you to access the alternatives universe. So if you look at fixed income portfolios, you can invest up to 10% in unlisted credit, and that is an unlisted investment is a type of alternative investment. So in the money market fund, like we've got the enhanced yield, the income plus, the flexible income, you do get a little bit of that. So what you tend to find with the fixed income managers, if they really like a position and it is an unlisted credit, they'll try and motivate the issuer to list the instrument on the Johannesburg Stock Exchange. So that's one mechanism. In the local space, the other alternative investment more and more that you get into is the retail hedge funds, but that does come with a little bit of complications. The biggest one is institutional hedge funds are far less frequently traded, and by what I mean there is you could have an exit term of a month or 2 months or 3 months, whereas the retail hedge funds need to be daily traded, and that does shorten the duration of the positions that a hedge fund manager changes, and it's because of the necessity of the unit trust legislation. So there is a small difference in flavor between an institutional hedge fund and a retail hedge fund. So that's the one. In the global space, it's a much bigger opportunity set. So if you look at feeder funds and global funds, you can access a richer exchange traded fund universe. And one of the portfolios we manage is called the Future Trends Fund, where we look at things like space exploration, demographic shifts, pharmaceuticals and healthcare, technological innovation. So there are bespoke exchange-traded funds globally that capture specific themes, and that is one way of looking at an alternative investment universe. The other investment option that you have in the global space that you don't have in the local investment markets are trusts. So you can list a trust with the underlying investments being infrastructure or direct property. So that is a bigger universe. And there are a couple of infrastructure investments that are accessible through a feeder fund. So there are mechanisms, but it is quite constrained by the unit trust regulations. In the institutional space and the large fund space, it is a little bit different. But I mean, obviously it comes with different sort of risks. And the biggest one that you probably want to be mindful of is liquidity. As you go into more unlisted and longer duration investments, it comes with an illiquidity impact. And part of the attraction of these alternative investments is you pick up the illiquidity premium, which is not really accessible in the retail space.
That's very interesting and very complicated, which is why we need the experts to help us with these alternative strategies. Very interestingly, I'm not sure if you're aware, but our Momentum Global Investment team recently got exposure to an alternative asset class in the form of an income that you get from investing in royalties from music portfolios. So that's something I'd never heard of. And it seems like there are constantly different alternative strategies. And that's why we rely on experts around the world to give us guidance so that we are always on top of what is available in the investment universe. Rian, is it actually possible to access these strategies that Mike was speaking about in a fund of funds or a model portfolio?
Yes, so broadly speaking, for a fund of fund, I would say yes, because as Mike said, liquidity is an issue, and for most of the unlisted investments, you don't have daily liquidity. So, but that liquidity burden can be managed within the fund of fund. So, broadly speaking, a fund of fund can access most of these alternative asset classes. For model portfolios, it's a bit more tricky because the access, obviously, these unit trust needs to be daily traded and daily priced and available on a list. So for model portfolio, it's slightly tricky, but they do have access to hedge funds. And we've seen the number of hedge funds available on list platforms grow quite rapidly over the last number of years.
So the main thing in a model portfolio is that you actually have to invest in a collective investment scheme or a unit trust, and it has to be on platform. Otherwise, you can't get access to it. On the topic of hedge funds, I'm often asked to explain the difference between a QIF and a RIF, and I know that Mark referred to it earlier, but just for our audience, can you maybe explain the difference between the two?
Sure. So a qualified investor hedge fund, or a QIF, actually came into being, or that was the only way, for an investor to access hedge funds. A qualified investor, and a qualified investor was deemed an investor with demonstrable knowledge and experience in finance who could understand a hedge fund and the risks that obviously go along with investing in a hedge fund.
So is that another portfolio manager?
No, that was a private individual, but I think with the ability to prove that he's financial savvy enough to be able to invest in a hedge fund. Okay. And the minimum investment amount was 1 million rand that a qualified investor could invest in a hedge fund. So prior to 2016, which was when the local industry was regulated, that was the only way to invest in a hedge fund and only open to qualified investors. Subsequent to the industry being regulated, there's a clear distinction between a QIF or qualified investor hedge fund and a retail investor hedge fund. And on retail investor hedge funds, obviously they have much tighter risk limits to protect the retail investor, and the minimum investment amount is also lowered. It's not 1 million rand anymore. It's more in line with what you'd find in a normal long-only unit trust or list minimums. So the hurdle to invest has actually dropped quite a lot.
Thank you. Speaking of risk, there's a perception in the market that hedge funds are always more risky than traditional assets, or that they always include leveraging. Is that true, Mike?
I wouldn't say so. I think the potential for risk in a hedge fund is greater because you have the option of shorting a position. And as I've said previously, shorting, when you get it wrong, your position just gets bigger and bigger. And you have seen some disasters in portfolios as a consequence of that. But really what you need to look at is the risk management and what's put in place. So a well-managed hedge fund with daily risk limits is not necessarily more aggressive or more risky than a traditional fund. And also, it's not just equities that come into hedge funds. You can also have fixed interest hedge funds. You can have hedge funds with significantly less leverage. So there's a whole universe of available investment vehicles or investment types within hedge funds. So definitely, and that's the reason why you do have qualified investor hedge funds versus retail investor hedge funds. There's a bigger burden of due diligence. So you really need to understand what you're investing in. And the landscape is far broader and the risks are a little bit different. So as long as you go in with your eyes open and you either do the due diligence yourself or you rely on a specialist like Equilibrium to help you with those due diligence, there's no reason that it could be riskier. In the same way that if you had a long-only fund that only invested in one stock, that could be incredibly risky as well. Or if you have a credit fund that's got too much exposure to credits that go into default, that can also be risky. The key is the risk management and doing the right due diligence, either yourself or getting a knowledgeable provider to assist you with that.
Thank you. So from a portfolio construction perspective, is leverage something that you look at?
Yes, I think because it can increase the risk, it is something you should consider. But just tying in with what Mike said, it comes down to how the manager utilizes the ability to leverage and the ability to short sell. And what we've seen is, irrespective of the asset class the guys manage, so you can get a fixed income hedge fund more aggressive than an equity hedge fund. So you can construct portfolios by using shorting and leverage across the risk spectrum, irrespective of the underlying asset class. which makes it important to really understand the mandate, understand the specific fund you are investing, and know the role you wanted to play in your portfolio, and make sure you're getting what you expect. Yes.
Okay, that makes perfect sense. Does Momentum Investments only invest in equity hedge funds, or do we make use of the other asset classes that you mentioned earlier?
Definitely. So there's a different flavor, different risk spectrum of hedge funds, all the way from equity-centric hedge funds that are predominantly equity underlying with leverage. There's a mix of equity and fixed interest, all the way to fixed interest hedge funds. And they can be things like there's it's a market neutral portfolio, so there's no net leverage in the portfolio. You can have some racy fixed income hedge funds that have 400, 500, 600% leverage in the portfolio. So, it is a little bit of a, be aware of what you're buying, but we do have the full range, and there's also some replication strategies that we've put into our portfolios where we've ported alpha onto a variety of bank structures and put them into hedge funds just to replicate the profile. So, like I said, that's the thing with the alternative space. It's such a huge landscape. It's one word that probably tries to describe a universe that's even bigger than equities, bonds, and cash.
And do you source it from the asset class? So when you're doing portfolio construction, obviously as an outcome-based investment house, we believe that being in the right asset classes is the biggest determinant of us getting to our outcomes. So how does hedge funds fit into that? Because it's not part of our strategic asset allocation, right?
Yes. It can be tricky because it comes down to the specific fund. And without going too much into the technicals, you need to understand what will drive the fund's return and whether you want that in that specific asset class or not. So there's no use sourcing a fixed income hedge fund from bonds if it doesn't typically run a duration risk. Then there's no reason for him to do well or do badly, but he can play a different role. He can smooth the return profile within your bond portfolio or your bond building block. So it all depends on the role you wanted to play, and that'll drive sourcing. But typically the cash plus mandates are typically sourced from cash, and then the more equity centric ones sourced from equity. Fixed income is the tricky one because typically the guys do not run a lot of duration. So at first sight, it might not look like bond sourcing will work, but like I said, it can play a different role within your bond building block.
Okay. So when we do portfolio construction, we try and put together portfolios that not only aim to get us to the outcomes, but also how we get there. The journey is important. And I think understanding downside risk and where it's coming from and the return profile is very important. I think, lastly, people think that if you appoint a discretionary fund manager like Equilibrium, you can automatically invest in hedge funds as long as we, the DFM, are managing the portfolio. But this is actually not the case. Each advisor has to actually have that alternative asset class on their license or class of business in order to be able to give advice on it. So you'll see that we don't include hedge funds, for example, as part of our normal standard model portfolios. But if you, as an MFP advisor, do have this category of business on your license and you are interested in investing in it, you're welcome to contact any of us or Rupert and Ronnie, your two portfolio managers, and we'll talk you through the hedge funds that we do rate highly. Thanks to both of you for joining us today. I'm sure our advisors will agree that this is a very specialist area of investments, and it gives me great comfort to know that I've got the best team helping us with these hedge fund strategies, not only locally but internationally, and that we're constantly evaluating what strategies are available and how we can make use of them to help you manage downside risk, but also to find alternative sources of alpha for your clients.
Thank you to everyone on our panel for sharing your views with us today. Alternative assets are always interesting, and it's exciting to see how you will be incorporating this into the MFP Houseview solutions. Next, I would like to welcome Rupert Gissing, a client fund manager at Equilibrium Investment Management, who will give an update on the MFP multi-asset Houseview solutions. Over to you, Rupert.
Thank you, Hugo. After a brutal 2022, investors went into 2023 worried about persistent inflation and expecting a recession by the second half of the year. Instead, inflation, though persistent, has started cooling and economies have remained solid. For most investors, the final quarter of 2023 marked a much-needed comeback when it came to both equity and bond market performance. 2 months into 2024, the consensus forecast for the global economy remains cautiously optimistic, with most central banks and analysts projecting either a soft landing or potentially no landing at all. But many uncertainties remain and market fragility is still prevalent. Debates will likely continue to focus on whether global economies will avoid recession and whether inflation will stay on its moderating path. We are already seeing a reduction in optimism amid speculation regarding the number of rate cuts we can expect during the year. Add in ongoing global conflicts and geopolitical tensions, as well as a calendar filled with elections, and financial markets promise to be filled with volatility for the remainder of the year. 2024 is due to be the busiest election year ever, with nearly half of the world's population in 76 countries going to the voting booths. It is, however, important to block out all the noise and to focus on the investment opportunities we can capitalize on for the rest of the year. So, how did it play out during the last quarter of 2023? The increased optimism for a Federal Reserve rate cut in 2024 was the main proponent of the positive trend in December, which seemed only fitting in a year where market dynamics were often influenced by investor sentiment. Global equity was the best performing asset class in 2023, with the MSCI All Country World Index, or ACWI for short, returning 31.3% in rands for the year, after adding 7.8% over the last quarter. This performance should, however, be seen in the context of how it was generated. Most of this has been driven by the so-called Magnificent Seven, which includes the likes of Apple, Microsoft, Alphabet or Google, Tesla, Amazon, Nvidia, and Meta or Facebook. Of course, most of these names have been closely linked to the hype surrounding artificial intelligence and the narrative that it will change life as we know it. Collectively worth more than $10 trillion, those 7 shares alone are equal to roughly the size of the entire stock markets of France, China, Canada, the UK, and Japan combined. Part of the sheer magnitude has been their share price performance during 2023, up by 74%. These stocks contributed 59.8% of the total MSCI All Country World Index return for the year. It makes the solid return of 12% for the rest of the world's companies seem fairly pedestrian in comparison. As impressive as the Magnificent Seven returns were, it should be seen in the context of the inherent risks of such high valuations and market concentrations, as there are nearly 3,000 shares in the MSCI ACWI. On the upside, value remains in the broader index. Emerging markets lagged their developed market counterparts with a 3.9% return in USD terms, which brought emerging markets' yearly performance to 9.8% in dollar terms. This was mainly driven by another key theme for 2023, which was the disappointing growth data and negative news surrounding China, surrounding regulations and the property sector in China. Overall, emerging markets lagged developed markets by more than 10% for the year. As evidenced throughout the year, the local equity market was largely influenced by global factors, which helped to improve investor sentiment. That translated into strong year-end performance. This was supported by a favorable November headline inflation print, which brought the local market up 8.2% for the quarter to bring the year's performance to 7.9%. However, local equity returns continue to be impacted by the negative sentiment driving deratings, which is especially evident in the mid and small cap sector. A meaningful improvement in load shedding and more growth-friendly policies are required to improve general sentiment towards the asset class. The best performing sectors were financials and industrials, returning 21.8% and 16.6% respectively for the year, while resource shares ended the year 11.8% lower. Global bond markets had to navigate contradicting US monetary and fiscal policies, which led to increased volatility in the asset class. The US 10-year Treasury yield peaked at over 5% for the first time since 2007, as markets priced in stronger than expected US growth, as well as fiscal concerns before the strong rally to finish the year. The World Government Bond Index, WGBI for short, returned 4.9% and 13.1% in rands for the quarter and year respectively. Local fixed income assets were under pressure for most of the year on the back of local fiscal concerns and political risks before global factors underpinned the year-end rally. The All Bond Index, or ALBI for short, returned 9.7% for the year after adding 8.1% over the last quarter. The interest rate sensitive local and global listed property sectors responded positively to the interest rate cuts priced in by the market, which reduced the refinance risk faced by the sector. SA listed property added 16.4% over the last quarter to finish the year as the best performing local asset class with a 10.2% return, while global property returned 19.2% for the year. Possible interest rate cuts will impact the return prospects for local cash, which currently offers decent real returns, as evident in a 2.7% return by Steffi over the last quarter to finish the year on 8.06%. Although the rand had a strong month during December, strengthening by 2.7% against the greenback, the local currency ended the year 8.1% weaker, at 18 rand 56 to the dollar. A question that we get asked often is the impact of reduced demand for office space in the local property sector in a post-COVID hybrid working world. The following chart provides some valuable insights into the reduced dependence on office space in the listed property sector over time. With the weighting being taken up by the retail and industrial counters, specifically in the logistical space. Office space peaked in 2018 at 27.2%, but has declined significantly and is now sitting at 13.6%. There has been a structural shift in the asset class, with a reduction in the dependence on office space. The ongoing volatility in financial markets have put significant pressure on multi-asset solutions over the last decade. I found the following slide very insightful, illustrating the rolling 5-year returns for multi-asset low, medium and high equity funds from 2005 to 2023. These are the categories that our Focus 3, 5 and 7 house view solutions fall in respectively. Two things that stand out is that since the global financial crisis, the world hasn't returned to the way we used to know it, and meaningful inflation-beating returns have been significantly harder to come by. The other is the convergence between low, medium and high equity exposure fund categories. Investors at this point in time are not being rewarded for the additional risk they take in high equity funds. We understand that this makes your lives as advisors very difficult when explaining return dynamics to investors. But what is worth noting is how quickly things can change. Quarter 3 of 2023 was a tough quarter for financial markets, and our multi-asset solutions delivered associated returns. Fast forward back to quarter 4, and as mentioned earlier, due to the remarkable rebound in growth asset classes, the multi-asset portfolios delivered strong positive returns during the quarter. These might seem like small wins, but they add up over time and allow the power of compounding to work its magic. It also illustrates the importance of staying invested for a minimum of the recommended time horizon of the portfolios in order to maximize the probability of getting to the return objectives of the solutions. In the Momentum Focus Fund of Funds, Focus 3, 5 and 7 delivered returns of 5.6, 6.2 and 6% for the quarter respectively. The funds have also performed in line with or better than their CPI plus benchmarks over the 12 months ending December 2023 and outperformed their strategic benchmarks over periods of 3 years and longer. It has been difficult to get the higher CPI plus targets of the longer time horizon funds like Focus 7, but as we discussed earlier, it has been a tough environment for multi-asset high equity funds in general. Let's evaluate how our underlying investment managers fared. The Fund of Funds Local Equity Blend underperformed the shareholder weighted index over the quarter and year after outperforming in 2020, 2021 and 2022. Our property managers slightly underperformed their respective benchmarks over the quarter, with long-term performance in line with the benchmark. Please note that we have exited the Momentum SA Real Growth Property Fund and are now fully invested in a Catalyst SCI Flexible Property Fund. The Momentum Flexible Fixed Interest Fund, also used in the MFP Focus model portfolios, had a strong quarter and outperformed the All Bond Index by 1%, though it lagged over the full year. The Diversified Income Fund and Enhanced Yield Funds both had strong quarters in year and outperformed Steffi over both the quarter and the year, as well as all other time horizons. On the global mandates, the Momentum Global Sustainable Equity Fund performed in line with the benchmark over the quarter and year, while trading slightly over longer time horizons. The Momentum Global Emerging Markets Equity Fund outperformed its benchmark over 1 year. The rest of the global mandates also performed in line with their benchmarks, with the One Invest Global Bond Index Feeder Fund, the Coronation Global Strategic US Dollar Fund being new inclusions on the funds as part of the ongoing alignment of the fund of funds and model portfolios. Turning our attention to the MFP Focus model portfolios, the MFP Focus 3, 5, 7 and 7 unconstrained model portfolios delivered returns of 6.1, 7.2, 7.4 and 7.5% respectively for the quarter. All of the portfolios finished the year ahead of their CPI plus benchmarks since inception in March 2021. All of the funds have outperformed their respective peer groups. Let's evaluate how our investment manager selection fared on the MFP Focus model portfolios. Similarly to what we saw in Q3 of last year, Voort's underweight exposure to consumer discretionary and precious metals contributed positively to performance for 2023, as these sectors were hard hit during the quarter. Blue Alpha also contributed positively, as the fund benefited from an overweight position to local banks, as financial stocks was the best performer for the quarter and the year. Momentum Core Equity detracted from performance over the year, mainly due to the momentum or trending factor that came under pressure towards the end of the year. The biggest detractor to performance, however, was our underweight tactical position in global equity. The Momentum Global Growth Feeder Fund also detracted from performance relative to its benchmark, as the fund's exposure to Japan, China and the UK detracted, as they underperformed the broader equity market. Let's have a closer look at our current portfolio positioning from a tactical perspective for our multi-asset solutions. We make tactical asset allocation calls based on short and medium-term class views. Locally, we are neutral on SA bonds, even though the yields remain attractive. And a significant portion of the upside was captured towards the end of last year. We are cautious with the upcoming national elections and continued market uncertainty and global monetary policy decisions. Although the macroeconomic backdrop for South Africa is not favourable, SA equity displays attractive valuations and we therefore remain positive on the outlook for the asset class. As the best performing asset class in South Africa last year, market participants are bullish about the prospects for SA listed property due to anticipated interest rate cuts later in the year. However, we have some concerns, including limited diversification possibilities locally as well as refinancing risks. Therefore, we retain an underweight position to SA property. Similarly, on the global side, even though the opportunity set is much more diverse in comparison to local property, the asset class can be risky during periods of increased market volatility and uncertainty. We also maintain an underweight position. Globally, cash and bonds continue to be attractive. We've maintained our overweight positions in these two asset classes, opportunistically adding to our global exposure, given our revised strategic asset allocation in line with changes to Regulation 28. Global equity remains a valuation story, and despite some market participants anticipating a strong economic recovery, there are still some fears of recession looming amid sticky inflation and uncertainty related to geopolitical tension. We therefore retain a neutral position to global developed market equity while being overweight emerging market equity, with attractive valuations in the sector. In closing, you will recall from recent communication we sent out that we are making some changes to both the local and global equity building blocks in the MFP Focus model portfolios. This allows the MFP house view investment offering to align fully with MFP's advice philosophy. These changes will make it easier for you to decide on the appropriate execution for each client. The decision as to whether your client should invest in a fund of funds or a model portfolio needs to be based on their unique circumstances and requirements and shouldn't be affected by differences in the two underlying ranges. We have therefore made changes to ensure that the two are aligned as far as possible and will be consistently managed going forward. The changes were carefully considered, taking into account current and historical positioning across the ranges and finding a solution that is specifically constructed to deliver on appropriate diversification at portfolio level through its exposure to various asset classes, investment strategies and fund manager mandates. To recap, On the local side, we will be selling out of the Momentum Core Equity Fund, the Blue Alpha BCI Equity Fund, the Eilert Equity Prescient Fund, and the Voort Equity Fund. These assets are being consolidated into the following funds. Net Group Investments SA Equity Fund, managed by Lorium, 25%. Truffle SCI General Equity Fund, 25%. 91 SA Equity Fund, 20%. And the Momentum Trending Equity Fund, 10%. The Fairtree Equity Prescient Fund, which has been a part of the local equity building block since the inception of the MFP focused model portfolios 3 years ago, remains and makes up the final 20% of the local equity allocation. On the global side, we will be selling out of the Momentum Global Growth Feeder Fund and moving into the Momentum Global Sustainable Equity Feeder Fund, as already used in our global equity building block in the Momentum Focus Fund of Funds. This change will allow us to fully leverage the global equity exposure in the model portfolios to a fund that seeks to achieve both outperformance and improve environmental footprint and sustainability profile relative to its MSCI World Index benchmark. The fund is actively managed by our Momentum Global Investment Management team based in the UK, using a systematic, multi-factor and data-driven approach to selecting shares. It is sub-advised by Rubico, a world-class specialist in environmental, social and governance factors and quantitative investing. As a specialist global developed market equity mandate with an MSCI World Developed Market benchmark, using the Momentum Global Sustainable Equity Feeder Fund is in keeping with our philosophy of executing via specialist mandates for each asset class. You may recall that the Momentum Global Growth Feeder Fund is a bit more diverse and includes exposure to other asset classes such as fixed income, infrastructure, commodities, and property. The Momentum Global Sustainable Equity Feeder Fund, SU for short, provides explicitly for sustainability criteria without compromising on expectations of outperformance above the benchmark, which is currently estimated at 1% per year. By design, it has a lower tracking error relative to the benchmark, which should also lead to a more stable return experience for investors. I hope you enjoyed the overview of our multi-asset solutions, and I look forward to seeing you at the next one. Thank you.
Thank you, Rupert. It's promising to see the solutions delivering on their outcomes. Ian Scott, our head of fixed income solutions, will look at the returns of the various fixed income asset classes and what can be expected from fixed income assets. Welcome, Ian.
Thank you, Hugo. Hi, everyone. Let's discuss what's happening in fixed income markets, what's happened over the last quarter or more, and what is that outlook for fixed income going forward. And as always, let's start with the US. What's happened? We're all waiting for the US. Why? Because we've seen this massive hike in rates since 2021, and now rates are at a top level, and the whole market is saying, when is the Fed going to cut rates? The market initially started the year saying, look, the Fed is going to cut rates 6 times in 2024. And then we said, whoa, that's probably a little bit too much. Let's taper it down. The Fed speakers came out and said, whoa, that's way too much. US inflation is not at 2 yet. Once we get to 2%, we will cut rates. The market sold off, and now the governor of the Fed says, look, we're ready to cut rates in the US, maybe just not yet, but just give us a little bit of time. That US curve is still very inverted, meaning the short rates are much higher than the long rates. So what is going to happen this year, and this is what we think will happen, is what we call a curve flattener, meaning when the Fed cuts rates, that front end is going to come down and that long end is going to go up a little bit, normalizing a yield curve, because remember, long rates should be higher than short rates. Normalized yield curve, there's a thing called the term premium of money. You need to be compensated for taking 10-year risk versus 2-year risk. Right, so that's going to be the big thing when that curve normalizes and the Fed actually starts cutting rates. Right, let's move over the pond to the EU. Now, we initially thought that the ECB would cut rates once the Fed starts cutting rates. We think that is changing. Why? Because the European economy, and especially Germany, is in recession. That's a problem when your biggest economy, 60% of your GDP, is in recession. We saw Governor Lagarde come out and say, look, the ECB may actually be forced to cut rates before the Fed. Wow, that's a big shift. Why is this important? Remember, the EU is still our biggest trading partner. Very important for South African yields. What will happen to EU yields? We're waiting for that cut as well. That's positive for EM. Right, what's the pricing in EM? When we look at the 5-year CDS, now remember, a CDS, credit default spread, what does it mean? That's the price that lenders have to pay in excess when they borrow in dollar markets. So if you want to borrow as a South African in dollar markets, you will pay around 230, 250 basis points above the equivalent US Treasury. We've seen that spread come down quite a bit. Why? Because the market is pricing that the Fed will cut rates. When interest rates go up, the CDS goes up. When interest rates fall, the CDS falls. So that's why you see that market moving to the bottom right. Market is pricing for better risk. When the CDS falls, it goes lower. That's good for South Africa. It's good for other EMs as well. So what's that chart? It's very important. Right, let's get to domestic markets. What's happening in the local South African market? One, bank funding curve. What is a bank funding curve? That's the interest rates where banks borrow from the market, asset managers, companies, or whoever. Right, what is that bank funding curve telling us? It's saying to us the market has reached the top. You can see the graph fairly flat or stable at the right end of the chart, telling us there's something going on because rates never just stay stable. They're either going up or they're going down. But what's important here is the red line is the 1-year rate, telling us it's below the grey line or the 3-year rate, telling us the market is pricing for interest rate cuts over the next year. Banks are not willing to pay more for 1-year money than for 3-year money, telling us the banking system in South Africa is waiting for the SARB, waiting for that rate cut, right? But what do we think about this is that the market will probably not expect rate cuts before the Fed has cut rates. So there's two things. One, we actually need the Fed to cut rates, which could be in the middle of the year. Two, we probably have to get over the South African election and what that actually means. So what is this market pricing at the moment? So there's a lot of, you can see 3x6 and 4x7, that's just terminology. What's important for us is a thing called 9x12 over the next year. So it means where will the 3-month rate be in 1 year's time? Let's not worry about the technicals, but you can see there's a minus 51 there. It says to us that over the next year, the market expects interest rates to be cut by around 50 basis points, which we think is very conservative. We think that the SARB could be more aggressive in the face of a Fed that could also cut rates a little bit more. So think about it. The market is now pricing that the Fed will cut rates about 75 basis points in 2024. We think that's very possible for South Africa as well. We think the SARB will follow, and they will probably cut rates somewhere between the June and November meeting by around 3 times, taking the repo from 8.25 to around 7.5. Right. When rates get cut, that's usually very good for duration assets. Yes, cash will have a lower yield, but remember, because of the capital element in bonds, when rates are lower and inflation falls, you get a capital uplift in bonds. So you can see what I'm alluding to, that we're getting into an environment that's good for bonds. But let's get back to that. What's happening in credit markets is quite important because think about it, a big part of our investment funds are in credit. Well, we still like credit. So from a probability of default perspective, credit in South Africa is still very good quality. So corporate South Africa is not tied to government South Africa. Yes, they do pay taxes in South Africa, but it means that the earnings that corporate South Africa generate, of which is probably 70% offshore, is not tied to the government. So it's a good strategy to diversify yourself away if you're worried about government South Africa. Yes, corporates do look okay. Yes, there would always be 1 or 2 outliers which are not great and they will always be in the market, but overall we like spreads. Right, now we're into bonds. Remember I said to you, when interest rates fall, you get that capital uplift in bonds, and that's exactly what is happening. So the curve at the moment is very steep. If you think that I showed you the US curve, which was inverted, the 2 years much higher than the 10-year, in South Africa you can see the converse. Our 2 years down here and the 10 years up at 11.75 and the long end closer to 12.25. Very, very high real yields. When we say real yields, we mean above inflation. So last year inflation averaged around 5.7. This year we think inflation will probably be around 5.5. So when we talk around 11.75, 7% real yields from South African bonds. But what's different to the last few years? Well, the last few years has been rates up, so capital losses on bonds. This year rates down, capital appreciation on bonds. So we think bonds are the most attractive asset class in South Africa. Why? And we'll show you the returns. We think there's very, very good returns to be had in South African bonds, especially over the next 2 years, because firstly you're going to get this underpin from the global environment where rates are being cut. The Fed, the ECB, the BOJ, all of them, they're going to cut rates, and that's going to support EM. So who's been the buyers? Who's been supporting the market? And I know we've heard in the budget that there's all these fiscal issues, and that's right. But foreigners have been sellers of South African bonds for the last nearly 5 years. So over the last year or more, who's actually been the buyers? It's actually been the insurers, the asset managers, and the hedge funds. I'd say over the last 2 years or so it was the banks, but what we've seen over the last year, and especially over the last quarter, is we've seen asset managers and insurers becoming big supporters of the market. Why? Because we're looking for these real returns. It's very hard for an asset manager to ignore 7% real yields available on government bonds. That's why they buy them. That's why we buy them. We own them. What's been the return? So you'd say, well, in an interest rate up environment, it's not going to be great for bonds. Well, the converse, or the numbers tell us something else. In the last year, if you were in bonds, 10.35 return. I said to inflation was 5.7, so you had more than 4% real return from bonds. Looks attractive to me. Inflation-linked bonds, 5.7 inflation, 7.5 returns. Once again, good. We like inflation because when we get up to 5% real yields, you're buying inflation-linked bonds at equity-like returns. Your cash was at 8 or 9. I think there's good returns still there. So in the next year, if inflation gets closer to 5 and cash rates are up at 8, 3% real from cash, you can't ignore that either. There's good opportunities, and you've heard me say cash is king, and cash is going to remain king. Why? Because of real yield, and secondly, because of fighting power. Because remember, when markets sell off, and they do sell off, even in good times, when you've got cash, you've got fighting power. You can buy quality assets at cheap prices. That's the power of cash. Looking at inflation bonds, why do we like inflation bonds? Well, because of the high real yields. I said to you, 5% real yield on 10-year ILBs. It says if I buy an inflation-linked bond for the next 9 or 10 years out to 2033, I can with certainty, a high amount of certainty, say you're going to get inflation plus 5. So let's say inflation averages 5 over the next 9 years, plus 5 real. That's 10%. That's not bad from this type of risk asset. And you don't have to have the white knuckle ride of the other risky asset classes, because I'm not always sure that the risky asset classes will consistently give you CPI plus 5 over the next 9 years if our economy keeps on growing at 1%. And we'll leave it there, but we like inflation-linked bonds. So what are the type of returns that we can expect from the various asset classes? So let's start with inflation. We said 5.5 this year. Cash will give you 8.5 to 9. So sure, inflation plus 3, 3.5. Cash is king. We own it in our portfolios. We like that. Credit around 9 to 9.5. We talked around the quality of corporates in South Africa. We think it's a decent yield and a decent return given the low risk profile that credit presents at this point in time. Yes, inflation-linked bonds might have the lowest return at this point in time, but remember, you're also buying yourself a hedge. If things do go wrong in South Africa, cash and inflation-linked bonds will be the two asset classes in fixed income that hedges you against severe rand weakness. Then obviously our favorite asset class, bonds. Why do we like bonds? Well, I said to you, they are very cheap at real 7. Double-digit returns, highly possible. Obviously there's a geopolitical element to it, and there's local politics that can affect the returns, But we think without stretching our valuation model too far, double-digit returns from South African bonds looks very, very possible at this point in time. We think it's a good place to be and have nominal bonds in your balanced portfolio. Cool. So we think there's good opportunities across the curves. But as always, what are the smiles and the dials and the monsters? So the smile is inflation is obviously falling across the globe. Will US inflation get to 2%? Well, we don't know. Will global inflation get to 4%? Well, we don't know. What we know is that inflation is falling, right? We talked around the Fed. The Fed cutting rates will drive interest rates lower across the globe. Then the SARB will follow. So we think the SARB follows the interest rate trajectory. That helps bonds, good for fixed income. And then remember I talked around the inverted yield curve. So when it normalizes, it actually says to foreign investors, look, yields in developed markets, especially the US and EU, doesn't look that great. But here in South Africa, those yields at 11 or 12% look very attractive. It actually pushes those fund managers and those hedge funds back into our market. So very good for EM. What are the monsters? It's obviously the fiscus. We're worried about government finances. We thought that the budget is trying to arrest the fiscal slippage, but I think the jury is still out there. Can government actually hold onto the reins of the fiscus? In an election year, I don't know, the jury is still out on that one. I think there is the risk of populism. We are in an election year. We don't know what it means, but that's why we want to have cash in our portfolios, because we want to have that optionality if there's a sell-off that we can buy quality assets cheaply. I don't have to talk much about load shedding. We know we're getting these bouts of 4, 5, 6, stage 6 load shedding. It happens, so that's still a negative underpin for South African growth. Then obviously all the SOEs, that's not great. So, you know, Eskom was always in the media. Now it's Transnet, but there's other SOEs that's also not great. It's not helping the bond narrative. Now I know for bond bears, they can easily say, yeah, but this and that and the next, and SOEs aren't great. So how can you buy bonds? You know, the question you always should ask is, but what's already in the price? We think a lot of the negative news of SOEs are in the price. What can change it is obviously when there's new negative news, Transnet says, well, we need another 50 billion or whatever that number is. Those are the risks. But as we always say, we think a lot of those negative news does sit in the price, and there's good returns for our investors over the next year or more.
Thanks, Ian. Richard Stutley, a portfolio manager at Momentum Global Investment Management, will now cover the performance overview of the offshore solutions within the MFP house view. Looking forward to your insights, Richard.
Hi there, and many thanks for joining us for this quarterly update. We'll be looking at the performance of the global models. Straight on, and I always like to start here, as you probably know, this is the team. There are 20 dedicated investment professionals in the team, not just one man and his dog. There they are. Hopefully you'll be familiar with some of those faces. If you're not, and you would like to talk to a Gregoire, you'd like to talk to a Matt Connor, I'm just picking a few names at random, pick up the phone and come and talk to us. That's the team, as I say, 20 of those. There are 2 key individuals involved in the management of our global solutions for the SA market. That doesn't mean we do all of the work, but we synthesize it and we oversee the portfolios. So that's me on the left, looking a little bit younger, and also Jade on the right. So next time you see this video, don't be surprised if I'm looking a lot younger, fresher, and generally better looking. The fact is, it simply isn't me, it is Jade. Don't be worried about that. Okay, getting into it, again, just as a reminder, I'm hoping you're all very familiar with this. What are the solutions where we have a cautious profile, and as is typical, a cautious profile will be investing the majority in fixed income, also known as bonds. That's on the bottom left-hand pie chart in this graphic. You move to the middle, we've got a so-called managed profile. It's trying to achieve a bit more growth by having a higher weight in equities, but still a decent chunk in fixed income. And then we have the growth profile, and I think we all know what growth means to us. So those are the three profiles. What do they seek to do? Well, here we go on this next slide here. This is looking at each of them over the long term since we launched them back in 2008. We've set them some targets. Can they deliver returns in excess of cash? And if we start at the top there, you've got the green line, the growth fund. Has it managed to deliver in excess of cash plus 5.5% per annum since we launched it in 08? Yes, it's done that. You've seen how it tracks that dotted green line, which is that cash reference rate. It's done that reasonably well. You go down to blue, that is then the managed profile. Has it managed to deliver that return of cash plus 4% per annum? Again, yes, it's done that. Remember, this is all in dollars, so you can add a few percent when you switch to thinking in rand terms. Finally, at the bottom there, the cautious profile. You can see straight away it is now in one of those periods where it's slightly behind the reference rate, but nonetheless over time, has it tracked it? Yes, it has. And it's been through periods where it's been slightly ahead, periods where it's been slightly behind, and we're currently in one of those periods where it is slightly behind. Why? We'll go on to that, but for context, I'm sure a lot of you will already know, but we've been through a decade where bonds, which remember from that previous chart, the cautious profile has quite a lot of, it's been a decade now where bonds have delivered exactly 0%. So that has made it quite challenging for that strategy. So that's the long-term returns. This is designed just to bring you up to speed on what's been going on in markets. I'm sure Q4 of last year is fresh in your minds for good reason. Thankfully, we saw a big rebound in markets. I'm sure you'll have seen that. So most things up, and what this chart is showing that thanks to that rally at the end of the year, most asset classes ended the year towards their highs for the entire year. So global equities, as you can see there, end up with a return of around 25%. What was their high for the year? It was that 25% figure. So at one point they'd been completely flat. They ended at the highs for the year. Contrast that with, say, in the middle of this chart, you can see global bonds. Global bonds at one point, per the blue column, have been down for the year. Again, they rally hard in Q4. They end the year, therefore, at their highs with a return in the region of 5%. So you can see pretty much a similar pattern across the board. Where's the exception? Well, look over to the far right-hand side. You've got commodities. They bounce between positive and negative returns during the year, hence the blue column crosses the zero line. Where do they end up? Well, they end up down. And I do think that's interesting because a lot of people would say, thinking or focusing too much, let's say, on 2022, they'd have said in 2022, commodities do really well. I need more commodities. Well, guess what? What happened in the next year, 2023? Commodities did poorly. You could have made money absolutely anywhere except in commodities. So a nice reminder not to anchor too much to the recent past. So that's asset class returns. Why did this all take off in Q4? As I say, I'm sure you'll have seen it in client statements. Why are markets suddenly moving up as aggressively as they did? And this chart aims to pick that up. And it's pretty simple. Look at the top two charts. That's the yield on a 2-year US government bond. Also, and then in orange, the yield on a 10-year US government bond, also known as a treasury. And those yields started to come down. Lower yields means higher bond prices. Lower yields means higher equity prices. Basically, everything just responded to lower interest rates. And that's what happened in Q4. I think we can see it, here we go, more clearly on this next slide. Again, simple picture. In orange, that's telling you that towards the beginning of that Q4 period, that's where market participants thought interest rates were heading, and so they were going to stay in that 5% region. They were going to slowly drift down to just over 4.5% towards the end of this year, 2024. And then all of a sudden, after a big change in expectations, we come to the blue line, which was taken at the beginning of February this year, and suddenly people think interest rates are going to be quite a lot lower than previously. As the orange line moves down to the blue line, that is interest rate expectations coming down, and that leads to those higher asset prices I've touched upon. Seemingly everything, as we saw on one of the first charts, seemingly everything made money in 2023. How could you miss, therefore, Richard? Well, there were easy ways to miss, in fact, and this may be of interest to some. At the bottom there, in, I don't know what colour you'd call that, pink or something, China, down very significantly in 2023, the world's second largest, or indeed the world's largest economy, depending on how you rate its currency. And nonetheless, an economy that big managed to deliver that poor a return. I think that is interesting. It tells you that big isn't always better. Anyway, you contrast that with how DM equities did at the top. That's the world line in blue. So stark contrast between these things. China, clearly an area to avoid, even if from a macro perspective, this emerging superpower, it may have seemed an obvious place to deploy capital. Well, it wasn't in 2023. Another interesting dynamic, as I say, everything went up, didn't it, Richard? Well, it did, but it certainly went up in differing proportions. Here at the top is the so-called Magnificent Seven. I'm sure you've heard that phrase to death, a bit like me, but that's 7 of the biggest stocks in the S&P 500. They're all tech-enabled. They're all great companies, the likes of Tesla and Apple and Amazon, etc. Anyway, they did phenomenally well in 2023, and that was really around this AI revolution, where we can suddenly see tangible output from AI in the form of tools like ChatGPT. They did extremely well. If you strip those out of the US stock market, the S&P 500, you go from that blue line, doing pretty well, all the way down to the orange line. So if you missed out on 7 stocks, that cost you 10% in 2023. And think about what it is to miss out on 7 stocks in the S&P 500, so called because there's 500 stocks in it. Well, 7 out of 500 is 1.4%. So you only missed out on 1.4% of stocks available, and yet you missed out on 10% of returns. That shows you that you really had to be in the right areas. We were in some of the right areas. I wouldn't claim we were in all the right areas. One more interesting one, I think, just on the backdrop, is thinking about everything that's been going on in the Middle East. We do think, particularly as we look ahead to this year, that geopolitics are going to be key, but equally let's not overstate some of the impacts. What this is picking up in red, you've got gas prices going back to 2022. In blue, you've got oil prices. We have, which certainly from a humanitarian perspective, certainly in terms of its potential wider impact, we have a devastating event take place in the Middle East. Is it significant enough, however, to move some of these key economically sensitive prices, some of these key inputs to production that therefore have a bearing on the economy? You can see, no, it isn't, because on the right-hand side, the chart is picking up what happened to gas prices, what happened to the oil price, and it really didn't respond very much to what happened in the Middle East. Certainly not anything like on the scale of 2022 when we have Putin's invasion of Ukraine. So those are some of the key factors in terms of markets. I think here we do. On the next slide, we jump straight into returns. So cautious profile at the top, work your way down to the growth profile. 3 months to the end of January, just because I think we do these recordings about quarterly. Really decent absolute and relative returns. So cautious up nearly 10%, growth up nearly 14%. How does that compare versus the reference rates we look at, i.e. the cash targets we've set ourselves, and also the peer group median, because one could always use a different fund? Well, that compares really favourably. Now, as we move right, we've got longer term periods that quite frankly are more appropriate to think about. Things move around a lot over 3 months. What's really important to us is what we're doing for investors over some of the investment timeframes that we've stated as relevant. And if we start at the top, in terms of the cautious profile, down 3.3% per annum over 3 years, that is very significantly behind the cash reference rate. That is also behind the peer group median. So why behind the cash reference rate? Well, over 3 years, we're down just over 3% per annum. Bonds, remember I said there's a lot of bonds in a cautious profile. Those bonds are down 6% per annum. The picture doesn't get much better over 5 years. Those bonds are down 1.2% per annum. Over 7 years, those bonds are flat. And over 10 years, as I mentioned previously, those bonds have again returned absolutely nothing. So that's the environment we're in. That is the challenge. And that is why returns aren't where we'd like them to be. Nonetheless, we're also behind the peer group median. So that, merits consideration as well. I don't look at all of our peers. Sometimes I do see what they're doing. Sometimes I do talk to some of my peers in the industry. What I think is going on there is that those peers are largely anchored to US assets. And as we'll see in a moment, those US assets have done considerably better than most other parts of the world. We don't think that will continue. We don't think exclusively buying US bonds and US stocks is the way to go. So we're sticking with our positioning. One other factor to note here that I think is interesting, over 3 years, you say to me, well, Richard, I'd have done much better just sitting in some kind of cash. I certainly wouldn't have lost 3.3% per annum. You're right. But if you'd left your money in some pretty sensible currencies, sterling, the euro, the yen, you'd have lost of the order of 1.5% per annum. So it's really been a period that has favoured one thing, and that is US assets. And while we've had plenty of them, we probably haven't had as much as peers. So 3 years, absolutely not where we'd like to be in cautious. As you start to move further out, then the portfolios start to look more like themselves, as does our performance. So managed over 5 years, nearly ahead of its reference rate, in line with global peers. And then growth over 7 years, which is kind of the minimum recommended holding period we have for that strategy, 6.4% ahead of cash, ahead of the peer group median. So back where we'd like to be. Point being, in cautious, it's a relatively short-term period, not one we're obviously happy with, but over time we'd expect performance to come back. Again, looking just at the short term, this is Q4 2023, what worked and what didn't. Commodities, which is our gold allocation and our allocation to gold miners, that was really beneficial, that was a positive. Real assets, things like our infrastructure investments, those were really positive. What worked less well, our equity allocation. We should have had more again in the US, which takes off and outstrips Japan, outstrips the UK and all these other regions. So we should have had more in the US. Within the managed fund and the growth fund, you can see that fixed income positioning in cash didn't help either. And that was because we were a little bit too defensive in a period when things really took off. But nonetheless, think back to the previous slide, absolute returns in excess, well, close to or in excess of 10% still means we've had a very decent recent period, even if there were some drawbacks as mentioned here. What we've got here is the long-term success rates on the portfolio. So managed, we've said, hold it for around 5 years. It should deliver a return similar to cash plus 4%. That isn't guaranteed, but can we reasonably consistently do that? Well, yes, we can. 75% of the time, as shown there. It's been through a period where it's been underwater. You can see how the green line dips into the grey shaded area, but it's now coming back and is very close to its target once again. So I think that looks pretty reasonable. Growth, you give yourself 7 years. That's a decent amount of time for ideas to work out. And indeed for market returns to work out. Market returns are pretty consistent the longer you increase your window kind of reference period you're looking at. Over 7 years, market's pretty consistent. They're much more volatile over, say, 12 months. So here, success rate of 88%, it's doing what we set out to do. Cautious then, I've left to last because it's the same picture. Cautious has been buffeted by these twin shocks. You have COVID, first of all, that leads to that first drawdown you can see there. And then we're in this second drawdown, and that follows the second shock, which was the big bond sell-off in 2022. So cautious is in this period of drawdown, but again, success rate still in excess of 60%, and you can see over time how it typically performs. Do we think we'll get back to that kind of a profile? Absolutely, and you know, what encouragement can I give to that fact? Well, think about where we are today. Bonds all of a sudden, the 12-month or the 1-year US government bond, it's yielding 5%. That gets us back into positive territory. That therefore means we're quietly confident that this performance should turn around. We've spoken about bonds giving you absolutely nothing. I think you know about that. Another area that has been a headwind to performance for us is our allocation to the US. Simply put, over the last 10 years, what you've wanted to own is US equities, and the bigger the better. You've just wanted to be in the largest US equities. And what I'm picking up on this chart I drew the other day is those two themes and how dominant they've been for 10 years now. So each time on the top, we're looking at the performance of US equities against global equities, excluding the US. On the bottom, we're looking at the performance of large cap equities versus smaller cap equities. And anyway, wherever I've shaded a year, that means that either the US outperformed or global large cap outperformed. And what you see on the top is that if you sum all the shaded areas together, there are 8 of them. So 80% of the time in the last 10 years, US equities have outperformed the rest of the world. So buy the US, Richard. It's absolutely simple. On the bottom there, count the shaded areas. I think it's 7 of them. That means 70% of the time, large caps have outperformed small caps. Again, it's simple, Richard. Buy the largest companies. That is how we will win. We obviously caution about that, and I'll touch on a couple of slides. Why? First thing to know, I've titled this boom and bust. You know as well as I do, things that go up sometimes do come down quite rapidly. Top chart there, you're looking at the so-called tech bubble. So IT companies in the US doing extremely well and then coming down very rapidly. I don't think we're in a tech bubble type environment, but do know things that go up can come down. Another example on the bottom is just looking at Chinese equities. There was huge excitement in 2015 that investor access to these equities was going to be increased. That proved premature, it didn't come through, and look how the line subsequently rapidly collapses. So first of all, let's always remember that things that go up can come down, and therefore we don't necessarily want to chase things that are starting to look quite expensive. This chart here, plenty going on in terms of the graphic, but it's a bit clearer. You look on the right-hand side, as it says there, a regime has never dominated for 2 successive decades. So you go back to the 60s and you have the US so-called Nifty 50, which is basically buy the best, biggest blue chip stocks in the US. Well, that lasted for about a decade, and then it didn't work so well after that. In the 70s, you had commodities, again, worked for about a decade, not so well after that. We saw how commodities did just last year. I showed that earlier. The 80s, huge excitement around Japan, this great economy and this great corporate sector. I can tell you that the Japanese stock market, it peaked in December 1989 at the height of this excitement around Japan. It only just this year got back to those same levels. So 35 years later, it's taken 35 years to get back to where you were after the explosion of a bubble like that. So again, we do need to be a bit cautious about chasing things that have gone up, because will it happen again going forward? In terms of large versus small, it seems obvious you want to own the biggest stocks. They're the best companies, the best access to financing with the best products, etc. Strange then that this chart, which is picking up performance of the 10 largest stocks in the S&P 500 against the 490 other stocks, it's strange that it goes from top left to bottom right, and that is indicating that that strategy of buying big since 1957 has worked spectacularly poorly. It has worked in the last decade, it hasn't worked from a longer term perspective, and that's something we need to be and we are very conscious of. So overall, I don't want to be dismissive of the US. We're not dinosaurs, we don't bury our heads in the sand. We have a lot in US equities, we have a lot in Nvidia in case you're interested, but we do need to be cautious about chasing this area and maybe a bit like our peers, just exclusively buying US assets. There are other investments elsewhere, and many of them are much better priced today. In terms of portfolio changes over the last year or so, the key themes are adding to bonds. Bonds have got cheaper and yields have gone up. So when yields got to around 4.5% on the US 10-year, well, that starts to look quite interesting. 4.5% per annum, yes please. We added some bonds. As they got closer to 5%, yes please, let's add some more. So that's been one of the key themes, us buying bonds as yields have gone up. The other is just looking for areas that look completely beaten up and unduly so, because actually their fundamentals are reasonable. We talk here in June about adding music royalties, an area that was heavily out of favour. You may know from previous videos that was an area that came back very quickly, i.e. the company we bought was subsequently taken out in a bid from elsewhere. That increased the share price of the order of 60% overnight. So that idea worked out very well. Not all our ideas work out that quickly, but that's an idea of the value embedded in cheap things. Over on the right-hand side, we talk about another beaten up asset class we've added recently, which is essentially bank bonds, some of which were blown up after the Credit Suisse debacle in Europe, which you may have read about. Asset allocation views, we're staying a bit underweight equities, we increasingly like fixed income, and we increasingly like those beaten up areas which here are grouped under the term alternatives. Why a bit underweight equities? Well, they've got a lot more expensive, as you can see here, with valuations. That's a P ratio. P ratios moving up. Equities are more expensive. All things being equal, let's have slightly less of them. Instead, as I say, increasingly favouring bonds. If you look here at cash yields in orange, if you look at longer term bond yields in that pinky colour, they've all moved up. We'll be getting paid more and more to own these assets. And contrast that with the dividend yield in the S&P 500, well, that hasn't budged. So you'd have thought, as other less risky investments, they start to pay me more, you'd have thought I'd also get more on my equities. I haven't, and therefore we're less inclined to own those equities. Hence, we're slightly underweight. So finally then, just bringing it all together in terms of an outlook summary. Two hexagons on the left-hand side: inflation, monetary policy, economics. How is that broader economic outlook? How is it looking? Well, it's all, I think it's fair to say, more positive than where we have been. Inflation, the really bad inflation we've had, that seems to be under control. With inflation under control, that means there is the prospects of just slowly starting to cut interest rates. That's very positive for you and I with our mortgages, but also for investment markets. In terms of the growth outlook, we're not expecting anything spectacular, but nor are we expecting a really steep decline in economic growth, the kind of thing that one needs to be worried about. So those things are looking positive. Then in terms of the risks, of which I'm afraid there always are some, chief among those would be geopolitics. Things are still going on, obviously, in Europe, in the Middle East, and then China represents a key unknown. The other one being the banking sector. Now, I say this with a degree of caution because banks really had their moment, obviously, in 2008-09. Since then, they've been very strictly regulated. But outside of the top tier banks, particularly in the US, these banks do own quite a lot of commercial real estate, quite a lot of office buildings, and you'll know as well as I do that office building prices are under a lot of pressure. So that's leading to risk in those banks, and there could be a degree of contagion coming from there. So those then are the key risks. Where we say better year in prospect, what do I mean by that? I think the key thing to think about there is, as I mentioned earlier, the yield on a 12-month US government bond, basically the least risky thing you could possibly own, well, that is still around 5% today. So 5% in dollars is really the underpinning for all investments as things stand, looking through 2024. That is a decent place to be. With that, we have the important notes. Read at your leisure. And all that remains for me to do is say a big thank you for joining us. Thank you.
Thanks, Richard. And that's all from us for today. From my side, thank you for attending today's MFP Outcome Matters and your continued support. I trust that you found the content not only interesting, but also insightful, and that you leave here today with valuable information to discuss with your clients. Until next time, goodbye.